If global long end bond yields are flying, the cure is hawkish monetary policy. Powell's going out and does not want to be the guy that restoked inflation.
Is it really about inflation and the two dual mandates, or is it about making sure the US remains the reserve currency and it can finance the Treasury? It doesn't matter. In 9 months, he's a lame duck right now, and we're going to jack rates way lower. If you fast forward through the event, you're going to end up at the same place, which is this is still an easing cycle. This is still a Ponzi scheme.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another Roundup edition of Forward Guidance, and I'm back in action. I've taken the keys back from the inmates at the insane asylum, but Tyler has his camera off. It appears he got roasted a little too hard for his recent haircut that makes him look like a little TikTok zoomer.
Yeah.
Right.
Everyone was DMing me pictures of Al Davis from the Raiders with that shitty haircut. So I had to hide it, but I got a surprise for you guys.
Come on, Tyler, show us a little. Let's see. Oh, there.
Felix, I missed your jolly Canadian ass. We had Brett Johnson on last week, was pretty good, but yeah.
I heard it got a little doomery. Is that true?
Yeah, it was a little doomerish, but I don't know. It's good to keep the risks up front. How you doing?
Good, man. Yeah, I had a good week off. Stoked to be back in the ringer. No shortage of stuff to talk about. Lots going on.
We should make some sort of bet on here so that, and if you lose, you have to just go fully shave bald.
All right. Yeah, I'll do it. I'm pretty close to doing that anyway, but yeah.
you kind of have the haircut from that meme that's just like, what you want, fam? And he's like, just fuck my shit up.
Yeah, that's what someone posted that. I think it was my wife posted that on my Twitter. She was ragging on me the entire week. I was like, God damn it.
That's so good, man.
You gotta see. So we gotta get Austin to put up the Al Davis picture.
Yeah, exactly. So there's still a bunch of memes of roasting you up here in post. We'll fix that in post.
It was so good. I felt like a locker room just getting absolutely killed.
Good to be back, guys. We are recording the day before the big Jackson Hole Symposium coming out tomorrow morning. We have the Powell speech. So yeah, we're recording this Thursday. We're putting it out today as well. So you'll be able to listen to this, have a little primer, get our thoughts going into it. And we'll see how right or wrong. Probably wrong, but that's the way it is. Yeah, recording tomorrow. Jackson Hole Symposium. It's always a very interesting one because it feels like a moment where if you look at recent years, like in 2022, the last big one, Powell came out swinging hawkish and was mentioning that, it's where he said this idea of like, there will be pain. And basically what happened is that this is during the big rate hiking cycle and inflation was still cooking, and basically said like, look, we're going to hike. And if we get a recession, we're okay with that basically. And risk fell off. Last year at the Jackson Hole Symposium, he basically used it as a moment to kick off the rate cutting cycle. And then they went 50 pretty quick there. So it really represents this major pivot in terms of especially how Powell's thinking about monetary policy. So The context going into this one is that we'll run through a few charts here, but actually this tweet from Tyler's best friend, Andy Constant, has a good little framework of just how to think about the different scenarios. So the way he writes about it is that there's 4 outcomes. One is full surrender, indicating September is a done deal. Terminal rate is lower. He sees that as very low odds. Or you can get this dovish reaction, someone neutral supporting 2 cuts, one of which is in September. Odds go from 85% back up to 100%. I think they're a little bit below 85% right now. We got some pretty hot survey data this morning, which is questioning things. Or you can go outright hawkish, talk about neutral inflation, and NFP for August will determine if September is a cut or not. September goes to 50% odds. Or he goes outright hawkish, says we're always right, explicitly takes September off the table, big move down across the board, 10% chance. Mic drop. So yeah, let's hear your guys' thoughts on how you think about this. I think another thing I want to say before we actually get into that too is that I see a lot of, like, even in that framework, it's a lot of focus on the September cut. But what's important here is that we're actually also going to be getting this 5-year review that they do of their monetary policy framework. So the last time they did this was in 2019, and during that time, that's when they brought forth this like flexible average inflation targeting regime, which in hindsight is probably one of the worst looking policy shifts probably in history, you know. But the big reason they did that is because that was coming off a decade post GFC, where the risk was of deflation, not inflation. They couldn't actually get inflation, so they were running below target for so many years that target that they have at 2% was actually not being hit, but to the downside. We're in a completely different situation now. We've been above the 2% target for many years now, and if you follow the SEP data, and Along actually has some really interesting analysis on this, like if you follow the SEP data and it takes us till 2028 to get to 2%, that's like 8 years above target. So really interesting to contextualize that around what could happen. So what the hell do you guys think is going to happen?
I liked Andy's framing of it. I think it's funny because coming into this week, I think people had a generally, or at least my read of consensus on the narratives was like 25 or 50, and people had a pretty dovish tilt, I would say, to their assessment. And it seems over the past couple of days, probably just because of market action, this has changed. I've been of the view I don't really see much. I don't see any upside for him to be dovish, because if we get a consecutive, bad inflation data and a jobs print that shows still like a 4.2 unemployment rate, getting super dovish might be pretty not a great look. There might be risk there for him, particularly as he's on his way out and he's in legacy mode. And I think the other thing to think about is that this is Powell speaking. This isn't a committee of the FOMC. And last meeting, which we just got the minutes this week, which were pretty hawkish, it's clear the majority or bulk of the committee is not probably there on immediate cuts. Granted, it was before the bad labor print, but this is kind of, Powell doesn't have to do the lip service to the dissenters in this speech like he had to do at the FOMC, which I think he gave more airtime to that, to Powell, to Bowman and Waller, than he would have otherwise, just because playing the political games with Trump. So my take is that at best he just says data dependent and doesn't signal September. I don't know why he would. It's a much different situation than last August. Last August we had a yen carry blow up and financial stability risks going into this that he wanted to quell. And this one you have assets at all-time highs, and which they actually noted multiple times in the meeting minutes as well, valuation risk. So I just don't see a ton of upside in dovishness here. I don't have a good sense of what's priced into the market, but late August, it does feel to me like people sort of sleepwalking into it, saying, yeah, he's probably not going to be dovish, but I don't know what good comes out of it. And I don't know what good for asset prices comes out of it.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Just to your point on minutes, like, yeah, they came out before that NFP print, but these minutes get approved way after the NFP print, and they can tweak them and edit them. And then every single FOMC member has to sign off and approve it. So they can tweak the language a little bit, or like prioritize or soften things if they want. I still view it as a signal. And you look at some of these headlines here that we have, like several flagged risk of inflation expectations unanchoring. Like that is friggin' danger zone for monetary policymakers. You have the majority of them saw inflation risk outweighing employment risk. Yeah, but that one probably should change a little bit after the NFP. And then overall, a lot of them just see, that like the full effect of tariffs could take some time. And I think what's interesting is this is a good little AI chart, just looking at the sentiment indicator of the FOMC minutes. And you can see like the last one was really, really dovish. And we've just seen a pretty significant reversal of that into a bit more of a hawkish territory. So yeah, even though it came out before the NFP, I still think it's an interesting signal. And they know that this is going to be the last piece of news right before Jackson Hole. So I still view it as valid overall.
It's still very evident, even though I think people got over their skis in these last inflation prints, celebrating, tariff impacts kind of diminishing, because what a bunch of people also pointed to was this idea that, tariffs are masking all this really good progress that's being made. And then bam, services comes in hot and people are like, oh shit, wages rise when you cut immigration and the economy's fine and government spending 6% per year and you have to hire. There's no layoffs either. So it's a weak labor market under the hood. It's a labor market that's not growing. But I do think that they are correct to question whether or not cuts are the fix for the situation. I mean, you have a supply issue, you have a supply constraint, and we know what happens when you stimulate into a supply chain problem, COVID. So I think they're right to question that. Like that, these are problems the Fed can't fix. So it's going to be fun either way. I'm just excited, and I don't think it's going to help risk. Let's just put it that way.
I don't know one person that's been bullish about tomorrow. I mean, everyone has the same feeling. Like I think every hedge fund is so overprotected to the downside tomorrow. And I think Andy's percentages are completely off. I think our chances of him being dovish are a lot higher than we expect. Just because if your framework is markets are a political utility, it really flips everything on its head, where, I'm seeing stuff in the commercial real estate market where things are taking 75 to 90% haircuts. Check out slide 45. This is the National Federation of Independent Businesses. I think the Kobayashi letter posted this chart. It says, in July, 11% of small businesses said poor sales are the most important problem, the highest share since 2020 pandemic. This share has doubled over the last 7 months. In previous economic cycles, this has been a leading indicator for rising unemployment. It now signals that the unemployment rate could exceed 5% in the coming months. Small firms employ 62 million workers, 45.9% of all employees, according to Small Business Administration. So if you go back to that chart, you can kind of just see that previous slide. The light green line is leading the unemployment rate, and he's going to have to address this. There's massive imbalances here. Yes, the market is at all-time highs. Yes, crypto is close to all-time highs. Yes, easing into higher inflation it could be problematic. But you know what's more problematic? Go to slide 50. This is from Infonomics, my guy on Twitter, who's just really breaks down the macro so freaking good. The S&P is essentially just a piggy bank for the US at this point. This is the Ponzi, Ponzonomics, where imagine if he is hawkish and credit spreads widen, the 30-year yield goes through 5%, financing costs go outrageous. We're going almost certainly into a recession. And what Infra talks about, he does a great 22-minute spiel, is like, we already have a 5% budget deficit. If we have a recession, that's going to like 15%. And imagine the supply of treasuries that come when you have a 15% deficit. And maybe Powell, you immediately put the US into like third world country dynamics. I think I would flip all those percentages on its head that Andy Constant had and say, if the framework is, we're going to find out tomorrow what the framework is. Is it really about inflation and the two dual mandates, or is it about making sure the U.S. remains the reserve currency and it can finance, the Treasury? So that, I think they're probably going to talk about that because, it's a K-shaped economy, and we're going to have to address the fact that there's going to be even more supply. Imagine a 15% deficit. I mean, where is that going to come from? The long end? You're going to put commercial real estate's already taken 75% haircuts. Think about the tax dollars. You have a $500 million building. It goes to say $100 million in New York City or San Francisco. The pure tax dollars that come from those appraisals are drying up. At the same time, your infrastructure is failing, and you need more money for your unfunded pensions. And this is a clusterfuck, complete clusterfuck. It could cause literal pitchforks if he's too hawkish. So
I think most of the time that's the right way to think about things. The only issue is that I feel like this is his last moment to try to either solidify that he's not Arthur Burns and to fight for Fed independence, because yes, that's all true, but imagine what happens if they lose Fed independence and the long end goes to 7% and the dollar goes down 10%. That would probably be a much worse situation. And so you have these dynamics of, okay, it's his last Jackson Hole speech. You have this situation where, okay, now we're talking about trying to fire Governor Cook, right? So you have that happening. You have a lot of pressure on the FOMC from a top line level right now. And so I think most of the time I agree that that's the situation, the right way to think about things, and those odds would be wrong. But I'm just trying to think through, what does Powell want to leave? What's his legacy? Because it's going to be a legacy speech for him.
If he is hawkish, whatever, the market dips 2 or 3% and Trump starts tweeting, "Oh, we're going to replace him anyway," and then he gets the forward guidance narrative game of saying, "Hey, it doesn't matter. In 9 months, this guy's lame. He's a lame duck right now, and we're gonna jack rates way lower." And when that narrative starts happening, and you have Russia, Ukraine, massively disinflationary. Even though this is an event, I just think if you fast forward through the event, and you're going to end up at the same place, which is this is still an easing cycle. This is still a Ponzi scheme, and the other thing that doesn't stop in the middle of August until September is buybacks. You have the vol. If you look at the vol curve, I'll dig up this chart in a second, but everyone's already bid up this event in Jackson Hole. They bid up NVIDIA earnings, and you can see the vol curve is already super, super steep. And when the event risk goes away, I don't know. We could really squeeze here on even a hawkish, thing. And look, the short interest in IWM is massive from the speculators. I think we did that chart last week where you have a major swing. Yeah. So this is a great one. People have really degrossed. This last couple of days has been a massive hedge fund degrossing. You saw Palantir took a digger, and that unwound all the momentum trades. And you saw a lot of other stocks, got covered. And this is where the massive hedge fund, they cover their shorts, they get out of their Momo longs. And now that's kind of petered out. We'll probably mess around here for the next day till we get some headlines. But I think the risk is to the upside tomorrow, and everyone and their mom has Andy Constant's view of things. I mean, that feels like consensus to me. So
Yeah, especially with the position of that's gone into the lead up of it. Yeah, definitely sympathetic to that.
what I'm really watching is like if the 30-year goes through 5%, if the Japanese 30-year goes through 320, that's like a really important one too. And you get bond vol, then yeah, let's cut some risk. But geez, I think everyone's calling for that. And maybe I'm ridiculous, but
I think we generally agree with what you laid out. I would say those are like secular medium to long-term views. And I would also say that most of those are fiscal treasury type of things that are not addressed by the Fed. And so I reside in the camp that, yeah, Powell's going out and does not want to be the guy that restoked inflation. I don't really think he will, but the other thing is, I think it's a precarious place for risk, is that because if he is dovish, then you're more likely to get the 30-year blowout. But with valuations where they're at, and then you mention, the solution, like the solution to that's my point. The solution to the problem is not, and if anything, they might talk about tomorrow. He might talk about balance sheet normalization, which
yes,
is also long end problematic.
I
Um,
totally agree. Like I
so
think you
I
can see
just
that.
don't. I don't have a view. Like, I actually think they're going to cut in September no matter what. That's why I don't think. That's why I think the market odds haven't moved, because I kind of think that like the market is going to force a September cut. I happen to be of the view that comes because the market's lower from here. Yeah, I'm cautious because I don't think dovish Powell actually is a great thing, because I think that weakens the dollar and blows the long end out. Whereas central banks, if global long end bond yields are flying and moving into an uncontrollable state, the cure is hawkish monetary policy and putting downward pressure on growth and inflation via a hawkish policy pivot. So I don't think that happens. I don't know.
Wouldn't that have the reverse effect though? Like this is where the game theory is kind of interesting. Like if you're hawkish and wouldn't the long end blow out? Like, and vice versa, if you're dovish, you could actually see the long end rally.
We're talking initial knee jerk reaction versus a week from now. If he comes out tomorrow and says slam the fucking door or whatever, rates across the curve are going to sprint up, but then they're going to normalize. And I think the long end normalizes lower than where it would if he comes out.
I was thinking about this. I sort of like the idea of shorting the 2s and the 30s, because if you short the 2s and he comes in super hawkish, that's going to sell off, but you might get a little rally in the long end. If he comes in super dovish, the 2s will probably stay somewhat flat, and then the 30s are going to probably sell off like crazy. So it sort of feels like a win-win there.
I like that.
Yeah.
Finally Canadian you.
I'm short. We'll leave it there.
I think the long end is higher in 3 weeks, regardless of what happens tomorrow.
I agree.
Check out this chart though. This is kind of interesting. Go to slide 43. This was from Bloomberg, but this is his Jackson Hole speeches sparked big bond swings. And generally speaking, look at like when you get to these inflection points, like 2019, 2024, 2-year yields move down. I don't know. I thought that was kind of this is a kind of interesting chart. But you're probably going to get some bond vol regardless, which is probably not great for the liquidity trade. So it'll just be interesting how he messages it in the balance sheet. If he had, QT or does some weird acronym stuff, or I think eventually they have to address the inflation secularly and say, hey, we're moving our goalposts to 3-4% and we need nominal growth to delever the economy. And that's the end game. But when they say it, imagine how crazy. Imagine like
that's the thing. I don't know if they can say it. I think they're just gonna soft say it.
They're not gonna. That's the dollar would
to
go to the
zero.
gulag, and then
Yeah.
inflation would just blow.
But they
Felix, before
basically
we,
admitted to it with their actions.
yeah, I mean, cutting with 4.2% employment rate. Yeah, Felix, before we leave this topic of Fed, I just want to go over this something I don't think anyone's talking about. I think slide 36 I had. Actually, first chart is just this continuing claims. I thought this was interesting, pulled from this morning,
Oh, I love
showing
that.
how much DC is leading nationally. So I guess there is some effective Doge. Maybe it's not what everyone thought, but there's something going on in DC. So
Everyone's
that's
thinking the same thing. Like, what do these fucking people do?
yeah. So,
They're
but what I actually
extractors of value.
what I wanted to talk about actually is there's this interesting aspect to the Fed that probably Trump and Besson are very clued in, but not many other people. So the every FOMC meeting, there's 12 voters, 7 uh, board members, board governors that vote, and then 5 of 12 that rotate every year, regional bank presidents of the Kansas City and the Dallas and the Chicago and the Richmond, et cetera. And so there's 12 of those regional banks, and every year 5 of them vote in a rotating fashion annually. So on years ending in 1 and 6, in February, the reappointments of those regional bank presidents take place, or new regional bank president appointments. Those reappointments or new appointments must be approved by those 7 governors. So basically, every 5 years, the people manning these regional banks, who represent 5 of the 12 voting members at FOMC meetings, need to be appointed or reappointed. Why this matters is because everybody's been talking about, okay, we had Kugler, who was on the board, leaves in January. She's gone. She resigned. So now Trump has 3 of 7 board governors. Next year, presumably, in May, which comes after this February appointment confirmation, he will have 4 as Powell. He will replace Powell. But if you go to the next slide, why this matters going into February and why it makes sense he's targeting Cook, who's a Biden appointee, is another prong to the Fed takeover strategy, which is if he gets Cook out in the next number of months, he will have, even pre-Powell, he will have 4 of 7 board members at the Fed under his control.
And then you get Servos.
You get Zervos.
Yeah, and then you get Zervos and you have 5. So maybe Kellyanne Conway will make 6. But so this is huge because if he successfully, which it doesn't look like is going to happen, but if he were to successfully, even before Powell, get one of these other board members gone, who are all 3 Jefferson, Cook, Barr, Biden appointees, he gets a situation where going into February potentially can affect 5 other voting members for the next year because of the regional bank appointees. So
And then
I heard that
also
one talked about.
Jefferson is being considered for Fed chair too. So you wonder what's going on there as well.
Well, considered, aka, hey buddy, show us how dovish you can get.
Yeah, do your little dance.
Yeah. So who's the guy this morning? There was someone this morning who came out and said a former Fed guy,
Bullard. Bullard, I think.
Bullard, yeah. Former St. Louis Fed President James Bullard said, yeah, we need to go down 100 bips. I mean, they're all just coming out of the woodwork. It's a little ridiculous, but this is a full frontal assault on the Fed. Look, I think this is going to matter. I think we're in like the second inning of Fed takeover stuff, despite how crazy it's already been. However, I don't think that's necessarily a panacea for what I expect, on the market front over the next month or 2. It could be, as we get later into the year, could be a boost, but I think it's still treacherous in September.
This is probably a little divergent political philosophy, but there's, I mentioned him before. He's kind of a conservative political theorist, and this guy Curtis Yarvin talks about. He calls it the cathedral, and basically what he thinks the government at this point in time needs to be run like is essentially like a corporation where you have a CEO making all the decisions. And you can kind of see, the conspiracy theorists on the left think, oh, this is going to be Trump taking over everything. It's a monarchy. And you can make the
Sounds like
argument.
fascism a little bit.
Well, yeah, you can make the argument that it's really bad and scary. Look at what he's doing with Intel, and you're taking over certain corporations, or you're getting Fed governors out, and you're really clamping down on it. Or you can make the argument like, look what Bukele did in El Salvador in like
No,
10 years,
no.
and he took a third world country out, and in countries might be more, the strong man is coming back, and they'll be run like corporations more efficiently. But it's an interesting thought, because at the end of long-term debt cycles, if you don't have centralized power, then it's also interesting because the way Xi in China, he's kind of losing a little bit of power, and that's becoming more decentralized as we're becoming more centralized in all these decision making. It's like the irony of the yin and yang Western Eastern world is a lot of, it's fascinating if you step back and watch it from like the political philosophy.
I think it's a good vignette of like where this can go for sure. I don't know if I'm convinced of it being necessarily a good thing, but it's a good.
Yeah. Like, we know how big. I mean, we don't. This is how things die. This is how political systems die. Like,
This is how you get Weimar.
You can. Well, I kind of agree. I mean, I think you also can make the argument, though, it could be how it dies, and we'll see if that's true, or you could be a reemergence of American dynamism if you invest in the frontiers, and like that's also like look at all the stocks that are working. It's like really forward looking, like AI infrastructure is getting financed. Space
because we're in a low liquidity meme bullshit environment.
Yeah, but that could go on for years, and then it turns into
could.
Like
my point
is like everyone was calling bullshit for Amazon for 10 years, and then it pulled a profitable quarter, and you're like, oh my God, this thing's real. And like Tesla too, as long as you keep financing costs low enough, and they're not sociopath fraudsters. Granted, there's a lot of sociopath fraudsters when money is salubrious. but
I just think the incentives are so
that than some sort of massive credit crisis. Honestly, I would love free market capitalism to come back. And
why don't we just?
But we are so far past that. It's so ridiculous that people suggesting that being hawkish is even a possibility to me is just fucking bonkers.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Okay, so that point about how that's dependent on financing service costs, I think is a good point into what we want to talk about around Treasury auctions right now, because this has been a very interesting shift.
Yeah.
Lighthouse Macro, shout out to that Twitter account and their research. Really interesting stuff. This thread was fascinating, just looking at the long end Treasury auctions recently and how under the surface we haven't seen long bond sell off. It feels like everybody's expecting it to happen. And I feel like a lot of that reason is we've seen this bid because of these recession fears that keep coming forth. And then you get this like tactical rotation into it. But when you look underneath the surface, this whole thread is fascinating. So you can see we're starting to tail pretty aggressively again in Treasury auctions, and just digging a little bit deeper. It's not great. So the most interesting thing to me is just the change in who's actually buying at these auctions. So let me just, this one. So check this out. Foreign buyers have just been retreating like crazy from auctions. So a few years ago, we were at like 40% for foreign central banks. And this is just almost down. It's like, what is that? 30%, 28%, something like that now. And so who's absorbing that supply? It's dealers. And that makes sense because you see this talk about like SLR exemptions and things. So it's becoming this big rotation where for decades the US was able to finance the economy and their treasury through this foreign bid for treasuries and for U.S. debt and U.S. financial assets. Like that is the primary export of the U.S. But what you can see in these treasury auctions is this pretty notable shift towards this like domestication of U.S. debt, where foreign central banks don't want to own anymore. And so you can see this declining participation. And so who's covering that? It's the banks, it's the GSIBs, right? And okay, well, that's just, you can make the argument that's just an extension of like the US government in some ways, right? Like they are just this is financial repression in action, is that the people that are still freely participating in markets are pulling back. And then who's coming in is the people that are being repressed or basically being force fed these bonds.
Yeah. You know who's recommending a 70% portfolio to bonds right now? Vanguard. Are you kidding me? Like, are you kidding me with that? It's like it almost makes you wonder. And I did this tweet about these centralized, like passive managers. What are their real incentives? Is it just to finance the government? Because 70% bonds makes sense if you're just financing the government. But they were also the ones buying, the Austrian 100-year bond at 0%, and they're down 40% on it. Vanguard and BlackRock still own that shit. When are we going to reevaluate how the mechanism of pensions and 401ks goes to these bonds? Because if you have a massive change in the treasury market, and you're going to just basically stick your citizens with massive losses, granted they're older and they're probably like, oh, I'm playing not to lose. I'll take a haircut on negative real rates. But there's a point to be made. We're in a massive bond bubble. And
it's being force fed, right? Like, I mean,
yeah.
Okay, so I just want to say one more thing about these charts before I pull them off. But look at the top left one. So you can see just we're getting into that dangerous zone in terms of tails. They keep tailing. And I think this thread wasn't even updated before yesterday's auction, which was also pretty awful. So you keep getting these long end tails. And then it's just like the last resort, like financial repression, funding the government types that are coming in and footing the bill.
Yeah.
And it's concerning.
So this is my point, though. If Powell's legacy, if he's hawkish, fucking see you later. Like see you later. No
what
chance.
If he's hawkish and that leads to a bid in bonds because he protects the dollar, though?
Yeah, I guess. But
Powell doesn't control the 30-year. That's all the morons in DC who locked us into 6.5% deficits no matter what happens on the revenue side. Like,
I don't know.
By the way, a reason to be bearish in September is one of the worst months in a very long time for coupon duration issuance.
Interesting. So, I mean, there's definitely like, I'm super bullish over the long term. I could see, I'm definitely a little bit hesitant to make a call this next couple of weeks, but we all know how it ends.
Yeah. The direction is clear. It's just time horizon. Yeah, that's where I'm at too. Like I'm pulled back a little bit here because I just don't know right now, like to be totally honest. But you know where the medium term goes. You know where the long term goes.
I pointed this out last week, but it's pretty ironic because you have Besant. So this kind of is some points on my side, Tyler. A couple of weeks ago, you had one of the largest banks in Japan saying we're not buying any more bonds, Japanese government bonds, until the Bank of Japan hikes, because the long end's fucked and the currency's going to keep going down until they do something, their inflation problem's worse. Besant was on TV publicly saying that the Bank of Japan should hike at their next meeting to stop the long end rise, because Japan's long end is in the same problem globally. Everybody's long end is in, because inflation is a problem and they're not hiking rates. They're too loose monetary. And it's the pot calling the kettle black. He's right to say that global yields are dragging US yields up for sure.
Have you seen the Nikkei? Dude, have you seen the Nikkei? It's on fire.
Well, so he's calling on Japan to cut because they're too loose and the bond yields are going up. And it's like, meanwhile, he's saying Powell should cut, or he's calling on Japan to hike.
Yeah.
And he's calling on Powell to cut 150 based on the models, which the models say they should be hiking.
Yeah. It's crazy.
Yeah,
he's gone into, he's gone.
Right now.
Yeah, he's gone into politicking from talking straight. But there's still tidbits of straight shooting. But that's one where it's just like,
You know, another reason equity markets can't really sell off over the long period of time is there's so much money in this. This is my short volatility versus long volatility. Is like the risk is in bonds. Like your risk is just getting diluted and inflated away there. And if you look at the Nikkei, I got chart 48. Like their wages are going up. There's a demographic problem there. So all the labor unions are asking for wage rises, which is, theoretically, once you go from capital to labor, you actually see interest rates rise, because that means a little bit of people in a capital run system, there's an elite pocket of people, and now that money is getting evenly distributed into a larger group of people, and that causes inflationary pressures and wage growth, and now we're seeing the only way to keep your purchasing power, after a 40 odd year bond bull market, everyone was trying to short Japanese bonds for 40 years. Now it's actually working, the widowmaker trade. And now they're rotating out of bonds into equities to save their purchasing power. And in fact, Japanese banks are actually a great place to hide, because they're lending out the money back at home and they're repatriating capital. And it's like, maybe that's going to be a boom. I think it's boom times in Japan, to be honest. And that's a fascinating dynamic, because they're one of the largest owners. What happens when you're taking haircuts on your US debt and you're like, shit, well, why don't we just invest it back home if we're just like, if the self-reinforcing inflationary cycle, and our companies are actually growing earnings and they're dirt cheap. Like that, this is where all the global capital markets unwind here. It's fucking scary. And the only way you can kind of keep the game going in the US is you have to be dovish. Like you have to deal with. This is why Zervos is actually, he's a really fascinating, because if you've read him, he's a big, you can delever the economy through nominal growth. And he, over after 2020, we actually saw debt to GDP drop from like 130% to like 90%. And
yeah, because we had 8% headline inflation, that was probably really 15.
Yeah.
Nominal growth, delevering via nominal growth is just inflation.
Yeah. I mean,
the cost is inflation for sure.
And like, people will make shit tons of money in the market, and that's probably what we're gonna see. And our generation will have a wealth grab while boomers are stuck in bonds, and that's how the transfer happens. And it's happening in Japan right now. We're I don't know, we're probably years behind. We'll find out, but we do innovate better than anyone in the world.
Real purchasing power gets smoked. But the thing with this Japan chart I just think about is this so inflationary. So like it's, I mean,
they're the basket of global savings. And they're finally
I just don't know how you chase like this, just because the way that this has to be fixed is because it makes their inflation problem more, it makes their bond problem bigger because people rotate, and just someone's going to have to get hawkish at some point.
But that's the thing, is I think it can get so much worse before that happens. Like nobody's going to intentionally do that.
Yeah.
So it's just like, okay, well, instead we're just going to rip it hot. And I think that's why, like I tweeted today that I think the risk is much more about inflation than recession. Is like, and I'm pretty good. I'll run through a couple charts here, but I truly do think that the economy bottomed out, and that like April scare NFP report, like jobs data is the last thing to turn in an economy. Like you get the leading indicator data, then that moves into like corporate profits, into their outlook, and then it's like, oh shit, we gotta lay off some people or whatever, and then it hits the jobs market, or like we're not gonna hire anybody as much. So you see that sequence of events. And so what I see now is that if you look at the more leading or real-time data, is it feels like we've bottomed out. We're starting to head up higher. So this chart here is just looking at, this is some of the most real-time data you can get on just the state of like a nowcast of the economy. And it's from the daily Treasury statement, and it's the federal employment tax receipts that come in every week. And this chart, what's his name? Bill Wabuffo on Twitter. Definitely go follow him. But he updates this every week, and you can see like these growth rates are not something that would be happening right before recession hits. And so like if you're expecting this continuation lower in the jobs data, I just don't really see that happening when you're getting these sort of prints right now. Like this stuff will lead the jobs report by a couple months. So you have this going on. We got the PMI data today from S&P. Manufacturing is bouncing higher and services is holding pretty steady too. So you're seeing from the leading survey data that it looked like we bottomed. Maybe we just had like a super short recession in April, and now we're bottoming out and heading back higher again. This is another one too from the Philly Fed that came out this morning, and this is just looking at future capital expenditures expectations from corporate companies. And like, check out that point. Like we're right back to it. We saw this little blip, mid-April 2025. So maybe that was that minor recession that we had. But the direction is going in the complete opposite direction now. So you have that, and then you have this, secular commitment towards dovishness. Yes, we could get like this tactical hawkish moment as like a last jab from Powell, but I think it's clear, especially when you go through like what Quinn you're talking about of this like Fed takeover situation, like the risks are inflation, the risks are the economy getting overheated. It's not recession. And that yeah.
The long end is just so screwed. I mean, it just, there's no like, that's the way out. I mean, you're right, Tyler. The question about that I disagree with is that the approach, I feel like everybody's a crypto investor now. Everybody is a crypto investor, and FOMO and MOMO is all people base decisions on. Oh, I have to be long. I have to buy. Oh, like it would be as if.
I agree with you when Bitcoin went to that 124, and then the amount of pessimism I see, and it's pulled back, but like in a week, I mean, people want to like jump off a bridge because they bought the top. But if you zoom out, this is like a completely normal pullback in a bull market.
Yeah, agreed. I agree with that. I'm just saying that and this is where it gets super nuanced with your asset selection too. I think Bitcoin has digital gold properties that benefits it more than, a lot of other things, even Meg 7 for that matter. But, my point is just that this world we're entering of growing our way out of via nominal growth via inflation that's bottoming at 2.5, 3, and probably going to 4 or 5 if this stuff plays through, like that is not a world where eventually people will say, I don't care what the Fed, like,
they're all going to buy gold mines.
Yeah, exactly.
Gold mines are crushing right now.
The assets that people, exactly. The assets that, everyone's levered long to the gills, the meme stocks, the liquidity assets, like you spark inflation again. That's not good for liquidity assets. That's not good for high multiple assets. That's 10-year above 5. That's not good for multiples. Like so I think that's where I disagree most, is that I don't think the environment we're going into, I don't know when that shift happens, because they might kick the can another year or 6 months or into 26. I don't know. Maybe I'm not saying what I think market direction is over the next 4 months. That's a longer term thing I'm talking about. But I just think that eventually this whole like cheering on the Fed takeover and these other things, it just doesn't end well, is my point. I do agree if inflation isn't yet a problem, the economy's reaccelerating and there's no other alternative. Okay.
You know what I think it is if you look back, and I get so much heat on this, but if the last 40 years were about risk adjusted returns and you were in secular stagnation because everything was about value investing and everything was about, Warren Buffett, let's just do a yield play and we'll take some premiums in and then we'll buy a building, or we'll take some premiums in and buy a bond. What that does over a generation is it hollows out. It's why, Peter Thiel says, we used to take the Concorde across the ocean. We used to do hard things. In 3 hours, we would cross the ocean, but now it'd take 6 hours to cross the ocean. So we actually went back in time on, actually risk forward investing. And what I think is happening is after this period of time where it was just like, it was a way to move capital from the middle class to the upper class. That's all this last 15, 17 years of money printing was. And now you have to dilute the currency so badly that to stew actual real growth again. And it's going to be, you know, there's going to be stupid shit that happens. And there's going to be a lot of sociopath, you know, entrepreneurs raising capital at crazy valuations. And you're going to be like, how the hell did that guy get wealthy? They don't even produce anything. But then there's also going to be real stuff that happens. And the government policy is going to be to innovate. And that's what happens in first turnings, right? You have to, it might be highly inflationary and you're going to take all those boomer bonds and all that generational wealth that's going to get passed over the trillions of dollars. And that's going to get forced by policy into space stocks, into nuclear stocks, into all these cool pockets that there actually is like a TAM, and there is like a technological change that you can grow there. I think that's the next frontier, and you're better off doing that than why the fuck would you ever invest in I don't know, like a regional bank? They basically lend to commercial real estate. Like that's how they made up the gap of growth from these large cap banks that just had massive deposits. There's sectors of the economy that is just going to be dead. And I think that's the only way out.
Actually, on that note, just a tidbit, I think financials are interesting short here because I believe bank reserve liquidity and scarcity is going to become a thing over the next 4 to 6 weeks and then beyond, because there's no RP. I think TGA refill is going to actually, for the first time in like 4 or 5 years, actually hit bank reserves. So they're going to have to either pull back, real credit creation or otherwise. And on top of that, you have, I think, long yields rising and hurting their asset portfolio via all of their unrealized losses. So, and I think credit spreads are at so that's 3 prongs, and I think credit spreads are going to widen from here. So I actually think in regional banks might be even the best short in the financials. So that's one thing I'm looking at.
Nice. All right, guys, I think we got to cut it there, but good to be back in the swing of things. We'll see how much of that looks good tomorrow after this speech.
Yeah. Good stuff, boys.
Good luck trading. Keep some sell stops in there just in case.
Tyler said this is another wine drink recap video.
Yeah. Look at here. You're gonna get your Friday recap of Budo Chizewski. That's what I keep Budo Chizewski, the old Boston salty guy.
Love it.
Stay tuned.
All right, guys.
All right, see you, boys.
You guys.